So, you're staring at your paycheck wondering whether to dump money into that 401k your employer keeps talking about, or start hoarding shiny metal like some kind of financially savvy dragon. Fair question. Let's break down the cage match between your 401k and a pile of physical silver sitting in your closet. First up, the 401k. This is the establishment's retirement darling, the sensible choice your HR department practically begs you to embrace. And honestly, for decades, it wasn't a bad deal. You get free money through employer matching, which is basically the only free lunch in finance. If your company matches dollar for dollar up to 3% of your salary, that's an instant 100% return before your investments even do anything. Try getting that from a silver coin. The tax benefits look pretty sweet on paper too. Traditional 401ks let you contribute pre-tax dollars, lowering your taxable income today while your money compounds tax deferred until retirement. Over 30 or 40 years, compounding does serious work. $10,000 invested at 7% annual returns grows to over $57,000 in 30 years. That's the magic everyone talks about. But, and this is a big but, those historical 7 to 8% returns your financial advisor quotes? They're increasingly hard to find in the wild. The average 401k balance for Americans 65 and older is a measly $82,000. Not exactly retire to Tahiti money. And when the market decides to throw a tantrum, your 401k goes down with the ship. In 2008, the S&P 500 dropped 37%, and 401k accounts lost over 25% on average. It took 5.5 years just to recover to previous highs. Then there's the fee problem. Most people have no idea they're getting nickel and dime to death. The average 401k charges 1.37% in fees for smaller plans. Doesn't sound like much, right? Wrong. A 1% fee difference can cost you $250,000 or more over 40 years, depending on your contribution level. And in 16% of plans, the fees are so high they literally eat the entire tax benefit. You're paying for the privilege of losing money. Oh, and try accessing that money early. Uncle Sam hits you with a 10% penalty on top of regular income taxes. So if you need cash before age 59.5, you're looking at potentially a 40% haircut depending on your tax bracket. Now let's talk about the shiny stuff, physical silver. Silver stackers will tell you it's the ultimate inflation hedge, the crisis insurance, the real money when the dollar inevitably goes to zero. And honestly, they've got some historical receipts. From 1970 to 1980, during the stagflation nightmare, silver prices exploded over 3,000%. Not a typo. 3,000%. Even recently, silver gained 148% in 2025 alone. The fundamental case is compelling. The silver market has been in a supply deficit for 5 straight years. Industrial demand is exploding, solar panels, electric vehicles, AI data centers, all gobbling up silver faster than miners can pull it out of the ground. China just slapped export controls on 60 to 70% of global supply, and COMEX registered inventories collapsed 77% in 30 days during January 2026. That's a genuine supply crisis. Unlike your 401k, you actually own the metal. No counterparty risk, no broker going bankrupt, no computer glitch erasing your account. If the financial system implodes, you've got something tangible. There's a reason central banks are quietly stockpiling precious metals while telling you to buy index funds. But let's pump the brakes on the hype. Silver is insanely volatile. In 1980, it crashed from $49 to under $11 in months. And just this January, silver dropped 31% in a single day, the worst crash since 1980. If you bought at the top, you got obliterated. Storage and insurance aren't free. You're looking at 1 to 2% of your holdings value annually, plus you need a real safe or secure storage facility. Try explaining to your homeowner's insurance why you've got $50,000 in silver bars under your bed. And when you sell, dealers buy back below spot price, plus you pay 28% capital gains tax because the IRS classifies precious metals as collectibles. The premiums kill you too. Normal silver products run 5 to 15% over spot price. During stress periods, that can spike to 50% or more. So, you're underwater from day one and need silver to appreciate substantially just to break even. Here's the dirty secret nobody wants to admit: silver doesn't generate income. Zero. Zilch. Your 401k stocks pay dividends, bonds pay interest, and both compound over time. Your stack of silver coins just sits there looking pretty. For young investors with decades until retirement, that opportunity cost is massive. So, which is better? Here's the uncomfortable truth: it depends on what kind of future you're betting on. If you believe the system mostly works, the dollar remains relatively stable, and markets continue their long-term upward trend, the 401k wins. Get that employer match, stick money in low-fee index funds, rebalance occasionally, and let compounding do its thing for 30 or 40 years. The math works if you're disciplined and the system doesn't completely break. But if you think we're headed for serious monetary chaos, dollar collapse, hyperinflation, financial system meltdown, then physical silver becomes legitimate insurance. Not your entire net worth, but a meaningful allocation. Oxford Economics research suggests 4 to 6% of your portfolio in silver specifically, with some experts recommending 10 to 15% total in precious metals for balanced investors. The smartest move? Probably both, but weighted toward youth and time horizon. If you're in your 20s or 30s with 40 plus years until retirement, max out that 401k match first. It's literally free money you can't replicate. Then dollar cost average into silver with maybe 5 to 10% of your monthly savings. You get compound growth from equities plus tangible crisis insurance from metals. If you're older, closer to retirement, or genuinely believe we're approaching a monetary reset, shift the allocation. Maybe 20 to 30% precious metals, less in equities that could crater when you need the money. The key is understanding what each asset actually does. Your 401k is a growth vehicle that requires faith in institutions and long time horizons. Physical silver is crisis insurance and an inflation hedge that costs you opportunity and liquidity. They're not really competitors, they're different tools for different scenarios. Don't fall for the extreme positions. The people screaming 401ks are a scam. Buy only silver usually have a YouTube channel monetized by bullion dealers. And the financial advisors saying precious metals are barbarous relics conveniently ignore every monetary crisis in human history. Build a hybrid strategy. Get that employer match. Keep fees low. Dollar cost average into both stocks and silver. Diversify across assets that perform differently in different environments. And for the love of all that is holy, don't put your entire retirement into either one. The traditional path of dollar dominance and stable 401k growth? That was a specific historical period, not a law of nature. The future might look different. So hedge your bets, stay flexible, and remember, the best investment strategy is the one you can actually stick with when markets go crazy and everyone's panicking. If this helped clarify the 401k versus silver debate, smash that like button and subscribe for more no-nonsense financial breakdowns. We're cutting through the hype on both sides to help you make actually informed decisions. Drop a comment below. Are you team 401k, team silver, or team both? Let's discuss.